A new income tax bill intended to replace the Income Tax Act of 1961 was tabled in Parliament earlier this week. The idea for the new bill is to make it far simpler for the taxpayer to understand. For example, a lot of cross-references have been cut out. One big change that would be welcomed potentially by taxpayers would be doing away with the terms such as assessment year and financial year. Because if you pay tax for financial year 24-25, it will be during the assessment year 25-26. So there's a lot of confusion with items like these. So now there is only one tax year. We spoke to tax expert Mr. Prashant Bhojwani of BDO India to understand what the salient features of the new bill are. The most significant change, Mr. Bhojwani reiterates, is that it's a simplified statute. For one, the language is a lot simpler. So now in the new bill, instead of words such as notwithstanding, you'll find words like irrespective of. Second, a lot of information has been distilled in tables or tabular form. This, Bhojwani says, will lend itself to easy interpretation, as a result of which litigation and disputes will come down. Despite much of the simplification that the new bill proposes, Mr. Bhojwani feels that some more amendments are in order in the upcoming couple of years. He says MNCs or multinational corporations coming into India still look upon India as being heavily compliant focused. So they find it a bit difficult to navigate the tax ecosystem here. As much as some things have gotten simpler, there are other areas where complexity is crept in. For instance, under the existing Act, if an NRI pays funds to another NRI, it is taxable in India only if it is associated with an India source. Under the new proposed bill, even if it is not an India-based source, it would still become taxable. This, Mr. Bhojwani feels, will have to be corrected in due course. One area where there is a significant change is for those filing returns even if they were under the exemption limit. So in the past, if they were under the exemption limit, but even then one of the triggers is satisfied, for example, if they made a trip abroad and spent more than rupees 2 lakh on that trip, they would still have to file a return. In the new bill, that requirement is not there, so such people need not file returns. In the past, there was an option of obtaining withholding tax certificates from the tax department for certain payments. So if I anticipate that my tax liability will be lower, I can approach the department for a withholding certificate, a lower tax withholding certificate. But that is there only for certain prescribed payments. In the new bill, those restrictions have been taken away. So for any income or transaction that you anticipate where your tax liability will be lower, you can approach the department for a withholding certificate. One example of a transaction where a taxpayer will benefit is in the sale of immovable properties. So if you're selling a house and you anticipate your tax liability is lower, then you can approach the department for a certificate for lower tax withholding. The other change is, if you're anticipating a refund under the new bill, you have to file your income tax returns within the due date. If you don't, you will not get your refund. An important area where the new bill introduces clarity is with regard to digital assets. Specifically, cryptocurrency and NFTs or non-fungible tokens have been classified as coming under virtual digital assets. There are other corresponding changes that the new bill proposes. For instance, if I'm transferring a digital asset, in certain instances for this transaction, I could get a no objection certificate from the tax department so that in future this transaction is not ruled fraudulent. Now, specifically, virtual digital assets have been included in this category as per the new bill. Under the existing Income Tax Act, penalties can be levied in certain instances on taxpayers only after they've had the opportunity to be heard their side of a case. In the new bill, that restriction has been removed. So a penalty can be levied if the person does not respond within the stipulated time. For more insights, visit thehindubusinessline.com.